Hello everyone, welcome back to my channel. So this video marks the end of the week number 73 in this road to 100k realized return challenge. And looking back this week, I think it's fair to say that this was a week of two halves. And the first half ended on Wednesday at the end of the trading day. And then the second half began on Tuesday. Basically, the information, the data that came that was released this week about on the jobs report on Tuesday and the inflation report, the inflation data coming up on Thursday, gave very mixed signs to the market, or very opposing signs to the market. And so markets basically went from a depressing mood until midweek, only to rebound on Thursday. But we will get to that. So first of all, nothing basically happened on Monday. There was some Fed speak, but markets basically didn't react too much, didn't give too much importance about it. The first highlight of the week was the jobs report that came on Tuesday, and basically what transpired is that this 64,000 jobs were added in November, and this was higher than expected because the expectation was only 45,000. And however, the markets, even so, they came down, especially because there was a revision made to the jobs in October, and apparently, looking at the news piece, apparently the economy in October shed or lost 105,000 jobs. And on top of that, the unemployment rate also rose to 4.6%, which was above the forecast. And I'm always a bit reluctant to accept this unemployment rate as a real unemployment rate, because any person who is working just a few hours, even if it is in some sort of a gig job, or is working, and now is very much a common term, the gig is working on the gig economy in a few hours per day, is already not considered for this rate, even though they would rather have a normal, stable, secure job. But because they are already in the job, even though it's a job in the gig economy, they are not counted towards this rate. So I believe that the real unemployment rate is quite higher than this one, but still, it was an uptick in the wrong direction, and this is the highest level of unemployment in over 4 years. And of course, this is also a concern. But even so, um, about this jobs lost, this was mostly because of a loss in jobs in the government. And even so, yeah, the most of the jobs that were regained here were in healthcare, which were about 46,000, and in construction, so which were the other 28,000. So basically, as you can see, the other sectors of the economy are pretty much struggling at this point. That's the clear takeaway that we can take from this. And so, yeah, we can see that the real economy, the economy, that the side of the economy that is really key and foundational to set up the pace of economic growth, yeah, is really struggling at this point. Even so, based on this data, the Fed futures, here it says that there was only 24% chance of a rate cut, But as we speak on Saturday, December 20th, it's slightly lower still. It's 22.1. Now, of course, the Fed meeting is more than a month away at this point. It will be at the end of January, but still, this is something that we will keep monitoring. But so far, no interest rate cut is on the cards, especially keeping in mind that the last few meetings always have served a rate cut. I think those last three meetings were a rate cut. So, yeah, this is something that for now the Fed may not be being may not have on top of his mind to have another rate cut for the time being, but we'll see what happens later on in a few weeks from now. Now, uh, also on Wednesday, there was another drop in the stock market. Again, concerns about the job market still lingering from the day before, um, and of this affected particularly the tech stocks again. But overall, in the market, the sentiment was uh, I would say pretty much negative. But on Thursday, the sentiment pretty much reversed because CPI, the inflation data, came out, and as you can see here, the headline reading was pretty much below or a fair way below the expected. 3.1 was expected, and of course opposing the 3% the month before in October. So this is a quite significant decrease. And this is the lowest inflation rate since early 2021, which is, I believe, pretty remarkable at this point. The CPI, the core, if we exclude, of course, the more volatile elements such as food and energy costs, it came even lower than the headline. So yeah, apparently this is something that was completely unexpected, and the markets reacted very positively to this. And so, yeah, this is basically what transpired on the labor market, on the inflation data, and this had also a spillover effect for the next for the next day on Friday. And on Friday, the markets continue their rise, especially the tech stocks, which were the ones that have been most affected in the last couple of weeks. Yeah, they rebounded quite strongly, and the Nasdaq ended up the week even slightly up. But yeah, so as you can see here, and looking at the chart of the Qs again, the Qs were our main focus again for this week. Let's see here the weekly chart. Yeah, and as you can see here, it was pretty much downhill the whole way until the end of Wednesday, but then opened with a huge gap up because of the inflation data, which was released before the market opened, and then yeah, another big gap here, and not so big of a gap, but some gap, and then as soon as the market opened, yeah, it just went with a very big upswing and then remained that way until the end of the day. So this was basically a week of two halves. And from the side of from our side and the side of the trading that we did, we did not do too many more trades after the latest video, and as you can see here, we only managed to collect a little bit over $533 for the week. And yeah, as you recall, we sold at the beginning of the week two puts on the RKK and also one put on the Nvidia. Again, why is that? Because since the tech sector was pretty much depressed, reflected in the Nasdaq, the Nvidia being the biggest stock in the index, probably serves as the best proxy that we have for the Nasdaq, but at a much less expensive price, and so you don't need as much collateral to be exposed to the stock, and so that's why we basically went ahead. We sold the put, and also we went ahead and sold the puts for the RKK, which is a technology sector. Again, considering or hoping that we would capitalize on the fact that the tech sector is quite depressed at the beginning of the week, and we sold the calls as we showed the 5 calls on the Qs. Now on Friday, everything remained the same. No trades were done. These puts were somewhat close, especially Nvidia was somewhat close to be in the money at some point in the week, but then with the gains that we had, they reversed that we had from Thursday onwards. They reversed completely, and on Friday, I decided not to wait until they were completely worthless. Well, in the case of the RKK, we did. We bought back at 1 cent, but this was pretty early in the session, as you can see here. But we did not wait for Nvidia to become any lower in terms of premium. We bought those back, and with the money that we had, we went ahead and because we also had some buying power left, we sold a put for IWM here, expiring on the same day. We still managed to collect $19 here, and because we still had some buying power left, I decided to again go away from our strategy of focusing just on ETFs, and we sold a put on ExxonMobil. Why is that? Because considering that the Nasdaq is a bit depressed, and this was a quite positive day. Nonetheless, the market sentiment was very euphoric on Friday, and so there was no reason to believe that there was going to be a pullback. So I decided, let's bet on a stable company. Let's see if we can find a stable company with low volatility in its options, and with a stock price which is closer to our buying power, so we can sell a put on it. And I found XOM, which is ExxonMobil. Now here, as you can see, the premium was quite low, and the probability of profit of this was 91%, so I was not willing to take any chances, or hardly any chances at all, of being assigned. So we still managed to collect some premium. Of course, the return was only 16.5% annualized, so not that much, but this was just what I wanted, to have some extra premium without getting into too much risk. And even though this 116 put was somewhat close, I would say, during the day, even in such a positive day, this put was close to be assigned. You can see here there was a point in time it came even below the strike of 116. It went down all the way to 115.95, but then quickly reverted, and yeah, that's why, as you can see here, the put of XOM, like the calls on the Qs and the put on IWM, expired with no value, so we kept the premiums, and nothing else was needed in terms of commitments from our side. So at this point in time, that's where we stand. We have this buying power left, over 33,000 euros. So these are euros, not dollars. And so what we are going to do is to use this buying power as the best way we can next week, to continue to sell some puts on, yeah, probably IWM. I did not see where it has ended, but if the put, yeah, it still ended up with 1%, so it's uncomfortably, in my view, uncomfortably close to yeah, what I would consider to be an area in which there's not too much ground to continue to grow. Uh, yeah, I don't know. Probably we will go for Nvidia again. Uh, yeah, it's still some way away from its all-time highs, which was close here to yeah, here 206, 200, yeah, 207, 206. So yeah, probably this would be the way to go, especially keeping in mind that the Nasdaq still has some way to go as well to go to reach its all-time highs again. The distance is much greater for the Qs and for Nvidia than for the IWM, so this is probably the way to go. And as well, because 181, we can still sell two puts on the Nvidia. For example, even if we take this one, 96%. This is not real data, but real market data at this point. The market is closed, but even something along these lines for 172 and a half, something like this, still would allow us to get some good premium and be quite conservative, because we are, yeah, I would say quite a long way from the strike. But we will have to wait and see what's going to happen. But yeah, for the time being, I think this is pretty much it. Again, like in the like what happened in the previous, not in this past week, but in the previous one, we could have bought back the calls on the Qs. They were pretty much at 1 cent already during the whole day of Friday. But because the sentiment was positive, I decided to let them go, let them expire, in the hope that, because we're going to have a higher price at the end of the day for sure on Friday, and chances are the market will go up by the time the Monday session opens, especially because it's Christmas week, and usually during this time stocks usually tend to go up or slightly up. We are no longer at a very big distance from our strike of 630, so an uptick in the stock price will probably again, we already have some enough delta for an uptick to have maybe some good or sizable effect already on the premiums. And so I prefer to let the calls expire and sell new ones on Monday, hopefully at a slightly higher price, stock price than this one, so we can get some more premium on the way. But of course, we don't know if that's going to be the case. This is just uh, a bet that I'm doing, but yeah, so far we have been mostly right. The markets on Monday tend to open slightly up. This time may be different or not. We'll see. But for the time being, this is all. Feel free to leave your comments in the comment section down below. I'm also available on LinkedIn in case you would like to ask me any questions about the challenge or any other topic. And of course, feel free to like the video and subscribe to the channel. And we will reconvene either on Monday evening or Tuesday morning to start the week number 74 in this challenge. And I'll see you there.